Redfin is reporting a massive collapse in investor home buying in America. Specifically, they're reporting that investors are buying roughly half as many homes as they were a year ago. A 46% decline in investor home purchases in the fourth quarter of 2022, even bigger than the drops that occurred in '06 before the last housing crash. And these investors, particularly the big Wall Street investors, are running scared from the US housing market right now, which is of course going to cause home prices to drop by more, because these investors were what was supporting a lot of local housing markets in a metro like Las Vegas. But according to Redfin, there was a 67% decline in investor purchases in Vegas, a 67% decline in Phoenix, 63% in Atlanta, 62% in Charlotte. And an interesting question is, why are these investors bailing on the housing market? And it's simple, folks. They're running out of money. Data from Finsight shows that from the third quarter of 2020 to the second quarter of 2022, these Wall Street investors raised over $32 billion in mortgage-backed securities to go buy homes in the US housing market. But here's the problem now, folks. Over the last 3 quarters, you can see they haven't really been able to raise any money in the mortgage-backed security market. And that lack of funding is one of the big reasons why these Wall Street investors can't buy as many homes right now, is because the capital is not available to do it. Make no mistake, this is great news for you as a regular home buyer out there. The leverage is now swinging back into your favor in the US housing market, and in many cities, home buyers are gaining a much higher share of the home purchases. However, everyone, there's still a big problem in the US housing market that's going to cause prices to go down by more in 2023, and that's the fact that the regular home buyer, you guys out there, you're not really buying many homes either right now. There is a mortgage collapse occurring right now. You can see that mortgage applications to purchase a house in February 2023, they're at the lowest levels in a decade right now. There was a little run up in January. Well, that's over with already, and you can see these levels are down 36% year over year, and they're down at the same levels they were in 2010, in the middle of the last housing crash. That was when the last mortgage collapse occurred. We're in another mortgage collapse right now. Buyer demand is at a pitifully low level, and it's going to stay that way so long as both prices and mortgage rates remain elevated. Simply put, even with moderate price declines so far in the housing crash over the last 6 to 9 months, prices are still way too high. The regular American looks at the housing market, they look at a listing on Zillow, and they say to themselves, this is ridiculous. I don't want to spend $600,000 on a house that sold for $350,000 3 years earlier. And until that fundamentally changes, that house listed for $600 going down to $450, we're not going to see recovery in buyer demand. So these narratives you're seeing spun about a recovery in the housing market, they're, excuse my language, BS. They're not true. They're not supported by the fundamental data. Another way we know that we still haven't hit the bottom yet in this housing crash is because housing downturns take a long time. And typically the housing cycle in America lasts around 15 years on average. It's a 15-year housing cycle. And right now we're in the first year of a new housing cycle. Let me show you all what I'm talking about. This graph shows inflation-adjusted home prices in America going back all the way to the early 1960s. And what I want you all to pay attention to, everyone, are these humps or these peaks in inflation-adjusted home prices. You can see there's 5 distinct peaks over the last 50 years. These peaks in home prices represent the housing cycle. And we're coming out of a 16-year cycle from '06 to 2022, where we can now see prices have started to go down. And what this graph says is that prices will continue to go down for a long time. Typically, the downturn lasts anywhere from 5 to 6 years in inflation-adjusted prices. So if history repeats itself, we're going to see prices continue to go down probably until around 2025, 2026. And so what you have to realize as a home buyer or real estate investor is that history says that we are in the first year of what's going to be an extended downturn, and that we are not going to see a big recovery in prices for probably a decade or more. And that's the piece of this that everyone's missing right now. Everyone thinks so far that this downturn in the housing market has everything to do with Jerome Powell hiking rates. Well, of course, that's part of it. 6.5% mortgage rates will lower housing demand. But the fundamental truth is that the housing cycle lasts a long time and that we are likely not to see any major recovery for years and years and years. And of course, the one group of people, especially in the housing market, that's refusing to believe that this is the start of a multi-year downturn are realtors. And there's lots of propaganda being pushed by a lot of realtors right now trying to tell you that now is a good time to buy, suggesting that you should buy at a 6.5% mortgage rate and home prices that are still close to the highest level of all time. And the thing to understand about realtors, everyone, is that a lot of them know that time is running out for them. And a lot of them are going to have to get new jobs very, very soon. In fact, the Wall Street Journal just ran an article discussing how many realtors are now having to go back to their old jobs. So when you see realtors right now trying to sow the propaganda in the FOMO, just understand that their livelihoods are on the line, and a lot of them are resisting what's inevitable, that a lot of them are going to have to go back to what they were doing before. And as we can see, folks, the number of realtors in America right now is 1.5 million, 1.5 million. It's come down a little bit over the last several months, but this is still at an all-time high. The number of realtors, we're about 50% above the long-run average. And what do you notice, folks, is that during the last bubble, we had a big run-up in realtors. And then as the bubble popped in late 2007, the number of realtors crashed. Now, I think we're going to see a very similar thing occur. And so that's a metric to watch out for, everyone, the number of realtors in America. When you see that number start to go down by a lot over the next 1 to 2 years, you're going to know the crash is really on. And you're also probably going to know there's a bottom at some point. Once the number of realtors collapses by 20 or 30%, that's going to be a sign that maybe behaviorally it's a good time to get in. But of course, if you're a home buyer, real estate investor, you should make your decision based off the data and looking at the fundamentals in your housing market. And one of the fundamental data points I love looking at is a metric called house payment as a percentage of median income. This takes what your mortgage payment, your property taxes, and your insurance are and divides it by how much people make in a city or state. You can see right now on the West Coast, in a market like California, the typical house payment is 66% of the median income. And basically on the entire western half of America, in Washington and Oregon and Idaho and Utah and Colorado, that house payment to income ratio is 50%, which is no doubt why these areas are getting hit first and hardest by the housing crash. Meanwhile, if you head to the Midwest in a state like Iowa, the house payment is only 25% of median income, or if you go to Oklahoma, it's 25% of median income. So these states in blue, they're not going to have as big a housing crash because there's more affordability. Of course, looking at things at the state level is a bit deceiving, but certain states are big and have a lot of different cities with a lot of different things going on in their local housing market. So I would encourage you folks, understand what the house payment to median income rate is in your city and metro area. For instance, if we zoom in on Texas here and look at Austin, we can see the typical house payment of $48,000 a year in mortgage, interest, taxes, and insurance is 53% of the median income, which is $90,000. So Austin is still extremely expensive, even though it's already in a crash and prices have come down. Meanwhile, Houston, that ratio is 36%. So there's much more affordability in Houston, which means likely that the crash is not going to be as severe. And ultimately, what really scares me about the investors bailing out of the housing market, like I discussed in the beginning, is when they're bailing out of cities that are very expensive for the regular home buyer. So they've bailed out of Austin. They've bailed out of markets like Phoenix and Vegas. And with investors bailing on those markets with the payment ratios for regular buyers still so high, you can see how those housing markets are in a lot of trouble and how prices are going to keep declining. Finally, folks, I'm going to leave you all with a prediction about these investors and these Wall Street investors in particular. I think their decline in purchases in the fourth quarter of 2022, minus 50%, that was just phase one of their exit from the US housing market. And we are about to enter phase two of their exit. And do you know what phase two is? Phase two is a fire sale. It's a sell-off of their existing portfolio. Now, I don't think the investors are going to do this all at once in every city in America, but I think in particular cities Over the next 6 to 12 months, you're going to see investors sell off their existing portfolio because they're going to need to raise the cash so they can keep their operations going. And I think the two cities are going to be Las Vegas and Phoenix, because not only have investors blacklisted those cities from buying new homes, they're now experiencing big problems in their rental operations. For instance, the rental vacancy rate in Las Vegas, according to Apartment List, has skyrocketed to its highest level in 6 years. The same goes for Phoenix. And so that's a big problem for these big Wall Street investors, everyone, that the rental vacancy rate is surging just as interest rates have skyrocketed, just as home prices are going down. Vegas and Phoenix, I think the fire sale is coming in the next 6 months, with other cities to join the fire sale later in 2023. Now, a lot of you guys have been emailing me and messaging me over the last couple weeks, and you're saying things like, Nick, I'm hearing stories about bidding wars in my local housing market, or you're saying my friend just listed their house and they got 6 offers. And a lot of you are wondering, like, how is that possible if we're in a housing crash? The important thing to understand about the housing market, everyone, is that a good house priced right in a great neighborhood, that type of house will always have demand. So you are going to continue to hear stories and see examples like that. However, the bigger, more important thing to pay attention to is the broader trend and direction of the market. As I showed you in this video, buyers are out on the housing market. Lowest mortgage application level in 10 years. 82% of Americans say it's a bad time to buy a home, and price declines have started. And that's the direction that we're going to continue. But in the meantime, we could still see isolated pockets of strength. We can still see little rallies in the housing market. So I just want to make sure you guys understand that that's normal, especially for coming out of the winter season when inventory is seasonally low. But we're about to get a whole big deluge of new listings hitting the housing market in the spring as buyer demand is still nowhere to be found. So get ready for a pileup of inventory and even more price cuts coming.